The Chinese PMI data came in a little bit less than expected after the encouraging result we saw in March. You can see the April number coming out with a small down. Now, if we compare that to expectations, the red line here on the chart now is the consensus forecast. So you can see it's a little bit of a miss uh, in the most recent month of April. Should we be concerned about that? Does it undermine the story that the Chinese economy is putting in a base and beginning to show some sort of recovery? Well, interestingly, within that number, we had the export orders component, which has been a major drag on the Chinese economy, and that's again the pink line reaching a low of about 45.4 in the early part of the year has rebounded quite sharply over the last couple of months. It's still in the territory below 50, but it is an encouraging signal. So what might that mean for some other indicators, and should we be paying attention to this as opposed to the overall PMI index? So if we look at the export orders component and we compare that to, for example, global trade growth, and I'll just put those here on the screen. So now we're looking at the blue line as the Chinese PMI export orders index. You can see the sharp pickup, and the red line in this instance is world trade volume growth, which has obviously been quite negative, sitting down around about -1. So it does suggest that we might see or begin to see a turn in global trade volumes. Certainly when you look at some of the more export-oriented economies like Korea, for example, that's the red line. Growth there has been in exports down about 10%. There's some suggestion that we'll see an improvement there. Taiwan export orders is another one, has a very close relationship with the Chinese PMI export orders index. So we're looking for a bounce there. What might it mean for industrial production globally? Now we're showing here industrial production in the early part of this year, that would be February data, was down about 1%. So it was at the lower end of the range that we've seen since basically 2011. This is an encouraged pickup in the export orders index for China, suggests that, our thesis that the industrial production cycle is going to bounce off the bottom end of its range is looking supported by that recent number. So yes, disappointing that the PMI index was a bit worse than expectations. Too early to say that that's going to be beginning of a new trend. And in fact, if we look at some of the components, the export orders component in particular is actually a lot more positive. Now, I want to have a look at recoveries in US equities after previous downturns that we've seen. So if we think of the December quarter downturn here, I've identified that as a trough, likewise 2016, and so on and so forth. We've identified pretty much the major troughs going back to 1980. What we're interested in is just looking at sort of what sort of performance have we seen post those troughs. Now we're 4 months into this recovery, and the market is up the US equity market is up by about 17.5%. So how does that compare to previous episodes? So if we consider just 4 months and turn that into, well, look at 5 months, and I'm looking at all the previous recoveries that we just looked at before from major troughs. So the market, as we said, at the black line on this current occasion is up about 17%. That's slightly above the dotted red line, which has been the average recovery in 4 months, sits around about 16.4%. So somewhere around about the average performance or recovery after a major trough. You can see the range quite wide, anywhere from +4 to as high as +30. Now, these comparisons, we're also including periods where there were actually genuine fundamental reasons for the decline, that is a recession. So if I was to remove the recessions, and so what I'm doing there is I'm removing events such as 2009, because they were very strong recoveries, 2009, the early 2000s, 1990, and also the early 80s. We're left with probably more market-driven declines in the market, in the US equity market, and now we're looking at subsequent recoveries from those. And you can see here, there's our current situation, the trough in December 18, the market up 17% or so. It is a little bit above the average, which has been closer to about 14.5%. This really strong performance here, the one at the top, was that was in fact the 98 recovery, which was a particular strong one. So, the market is tracking, in non-recessionary periods is tracking quite high relative to the average. If we extend it out to 6 months, after 6 months, the average recovery has been around 20%. If we go out a bit further, if we go out to say 12 months, the average recovery has been around about 28%. So in this very sort of simple analysis of just looking at previous recoveries coming out of troughs, this current recovery is broadly in line, maybe slightly above the average for non-recessionary periods. But what it also shows is the recovery has continued on for quite some time afterwards. If we go out further, I'm going out to 24 months post, and we can see outside of this, the June 2010 recovery, most of them have been quite good, and the average cumulative gain has been around about 50%. So unless we are on the verge of recession, what this would suggest that there's more legs in this market.